Hey traders! Kindly listen to this.
Stop overcomplicating liquidity. I will show you how to accurately spot the different types of liquidity in no time. There are two main types of liquidity: internal range liquidity, or IRL, and external range liquidity, or ERL. Internal range liquidity is referring to fair value gaps. All you have to do is identify this three-candlestick pattern as seen in the image. External range liquidity can be identified by using swing highs or lows. A swing low is any low that has a higher low on the left and right of the candle. A swing high is any high that has a lower high on the left and right of the candle. The market is always going to move in cycles from internal range liquidity, or fair value gaps, to external range liquidity. When the market reaches external range liquidity, you can expect price to come into internal range liquidity. Let me show you this cycle in action. This is the daily silver chart. We have external range liquidity in the form of that swing high, and internal range liquidity in the form of that fair value gap. We expect price to move from IRL to ERL now. Price does exactly that. After taking out the initial ERL, we form a new ERL in this new swing high. We now expect price to move from the new ERL into the newly created IRL. After that, the cycle repeats itself and we move to the ERL again.
Wow! That's not enough for you traders. I feel like I am not satisfied with understanding this types of liquidity. Why a fair value gap on internal liquidity? He say, the cycle of the market is that the market moves from internal liquidity to external liquidity, which I totally agree. Traders, allow me to go in depth in explaining to you more of internal liquidity and external liquidity so that we can understand it better. So, what is liquidity? Let's start there. Liquidity zones in forex are instances where there is a high demand to sell or purchase a specific currency pair. 1. Identifying liquidity zones allows traders to get a sense of possible trends and price movements in the market. 2. To identify liquidity zones, you must combine volume analysis with finding support and resistance levels. So, what is external and internal liquidity in forex? But before diving deep into internal and external liquidity, we would be explaining some basic concepts to make it easy for you. Why price move? Have you ever thought that why price moves? Basically, price moves because of two reasons. 1. To sweep the liquidity. 2. To balance the fair value gap. What is ICT dealing range? ICT dealing range is basically the area between an established swing high, which has taken the liquidity of an old high, and an established swing low, which has taken the liquidity of an old low. Now let's move forward to the ICT internal and external range liquidity. What is ICT internal range liquidity? Internal range liquidity is the liquidity inside the defined range. External range liquidity, this could be in the form of any institutional reference that we can use as an entry, such as order blocks, fair value gaps, volume imbalance, and more. Anything in between an ICT dealing range is termed as internal range. But only the fair value gap is marked as the ICT internal range liquidity. Now you may question why only the fair value gap is marked as internal range liquidity, not the highs, low, or order blocks. ICT fair value gap is marked as the liquidity because it is a formation of three candles leaving an area between high and low of first and third candle where price do not overlap. So the high/low of the candle forming the fair value gap is basically an established low and a liquidity level in lower time frame. When price moves to balance the fair value gap, it basically sweeps the liquidity in lower time frame. That is why fair value gap is termed as ICT internal range liquidity. What is external internal range liquidity? External range liquidity is the liquidity that will be resting on previous highs and lows. These highs and lows are also used to define the range. This could be in the form of stops or pending orders. The highs and lows of any ICT dealing range are termed as external range. The high of an ICT dealing range is termed as buy-side liquidity, assuming the buy stops rest above the high of dealing range. While the low of an ICT dealing range is known as sell-side liquidity, assuming the sell stops resting below the low of dealing range. How to identify external and internal range liquidity. The first thing to do to be able to identify external range liquidity and internal range liquidity is to define the range you will be working within, using swing highs and lows to mark the beginning and end of the range. Choose the recent trading range relative to your specific time frame when defining your range. External range liquidity can act as a draw on liquidity based on order flow. Meaning if we have external range liquidity on the previous low and the institutional order flow is bearish, price will be attracted or pulled toward our external range. Internal range entry refers to any institutional reference point that we can use to either sell or buy. This could be but is not limited to an order block, fair value, mitigation block, and breakers. How price move to take liquidity. Price basically moves from external to internal and then internal to external. So price after taking the external range liquidity moves toward the internal range liquidity to balance the fair value gap, and then again price moves to the external range liquidity, and this cycle continues. Daily bias identification using ICT ERL and IRL. ICT internal range liquidity, IRL, and ICT external range liquidity, ERL, concept is beneficial for identifying the potential daily bias. To identify ICT daily bias, follow these simple steps. 1. IRL and ERL. As we discussed earlier, price moves from internal range to external and external to internal. So identify the ICT internal and external range liquidity in daily/weekly chart near, above and below the current market price. 2. Potential bias. If price takes internal range liquidity first and the external range liquidity is resting above, the bias should be bullish, as price is gonna take the external range liquidity. But if price takes internal range liquidity first and the external range liquidity is resting below, the bias should be bearish, as price is going to take the external range liquidity below. We are mainly focusing on the external range liquidity because it lies within the major trend of market, while internal range liquidities are taken by the price retracements. Scenarios after taking ERL. 1. In bullish market, if price sweeps and closes below ERL, old high, with reversal/momentum shift in lower time frame. This is a sign of potential bearish reversal. The market may now go down to take the untouched IRL, fair value gap, below. 2. Price closes above the ERL while there is no reversal/momentum shift after reaching ERL, old high. There can be two possibilities. Continuation of bullish trend, the market may continue its upward movement beyond the ERL. Consolidation, the market may consolidate around the ERL level before making another directional move. Note: this method is based on the assumption that the market tends to fill liquidity gaps and balance imbalances. It's important to consider other technical indicators and market context alongside this method for confirmation before making trading decisions. Back testing and paper trading are recommended to evaluate the effectiveness of this method in different market conditions. This brings us to the end of this video. Let me hope you have learned something. Do not forget to subscribe, like, and share. I will see you in my next video.